What if I told you that the most undervalued stock in the S&P 500 right now isn't a tech giant, isn't an AI play, and isn't even a company most people have heard of? I used Claude AI to analyze the financial statements of all 503 stocks in the S&P 500, looking at ROIC, free cash flow yield, earnings growth, and debt ratios. And the results completely changed how I think about this market. Let me show you what the data says. This is Alpha Decoded, where we use data and AI to cut through the noise and find what actually matters in investing. No hype, no predictions, just numbers. Here's exactly what I did. I pulled financial data for every stock in the S&P 500. Revenue, earnings, free cash flow, total debt, return on invested capital, and price-to-earnings ratios, all from their latest filings. Then I fed this data into Claude AI with a specific framework. I asked it to score each company on 5 dimensions. 1. Profitability. Specifically, ROIC minus WACC spread. This tells you if a company is actually creating value or destroying it. 2. Cash generation. Free cash flow yield, not earnings, cash. Because earnings can be manipulated, but cash doesn't lie. 3. Growth trajectory. 3-year revenue and earnings, CAGR. Is this company accelerating or decelerating? 4. Balance sheet strength. Net debt to EBITDA. Can this company survive a recession? 5. Valuation. Forward. PE relative to its own 5-year average and sector median. Is the market pricing this fairly? Each metric was scored 1 to 10, giving every stock a composite score out of 50. Now, before I show you the results, this is not financial advice. This is a data exercise. Always do your own research. Let's look at what the AI found. Let's start with the ugly. These are the 10 lowest scoring stocks in the entire S&P 500. What's immediately striking is that several of these are household names, companies that most people would consider safe blue chips. The common pattern among the bottom 10, high debt, declining ROIC, and valuations that don't reflect the deterioration. Let me highlight one example without naming it directly. Imagine a legacy industrial company. Revenue has been flat for 3 years. ROIC has fallen below its cost of capital, meaning every dollar it invests actually destroys value. Yet the stock trades at a premium to its sector. The AI flagged this as the worst value proposition in the entire index. And when I dug into the 10K manually, as a CPA, I always verify, the AI was right. The footnotes revealed increasing restructuring charges and a pension liability that most analysts are ignoring. This is why AI analysis is powerful. It doesn't have bias. It doesn't care about brand names. Now the exciting part. These are the highest scoring stocks. And here's where it gets interesting. The top 10 is not dominated by the Magnificent 7. Yes, a couple of large tech names are there. Their profitability metrics are genuinely exceptional. But the majority are mid-cap companies that most retail investors have never researched. The number 1 stock scored 46 out of 50. Let me walk you through why. ROIC of over 30%. That's more than double the S&P 500 average. This company earns exceptional returns on every dollar it invests. Free cash flow yield of 7%, meaning even at today's price, you're getting a substantial cash return. Revenue growing at 15% annually for the last 3 years, with no signs of deceleration. Net debt to EBITDA under 1 times, essentially a fortress balance sheet. And here's the kicker. It trades at a 20% discount to its 5-year average PE. The market is underpricing this company relative to its own history. Why? Probably because it's not an AI story. It's not sexy. It doesn't make headlines. But the financials are objectively among the best in the entire index. But here's the most surprising finding from this entire analysis. It's not about individual stocks. It's about a pattern. When I plotted ROIC against valuation for all 500 stocks, a clear cluster emerged. There are approximately 40 stocks with above-average profitability that are trading below average valuations. In other words, the market is systematically underpricing quality. Why? My theory, and the AI agrees, is that most of these companies are in boring sectors: industrials, healthcare, consumer staples. They don't get the attention that AI or crypto stocks do, but their fundamentals are superior. I went back and tested this. If you had bought the top scoring quintile from this analysis 1 year ago, you would have outperformed the S&P 500 by about 4 percentage points. Not a guarantee for the future, but a compelling data point. Let me be transparent about something. I've been doing financial analysis professionally for years, at a Big Four firm and at Fortune 500 companies. Before AI, analyzing even 20 companies in depth would take me an entire weekend. Reading 10 KS, building models, comparing metrics across sectors. With AI, I analyzed all 500 in about 3 hours. This isn't about replacing human analysis. It's about making the first pass 10 times faster, so you can spend your time on the stocks that actually deserve deep research. So, what should you take away from this? 1. The most profitable companies in the S&P 500 are not necessarily the most expensive. Quality is underpriced in today's market. 2. ROIC minus WACC is the single most important metric that most retail investors ignore. If a company can't earn above its cost of capital, it's destroying value, no matter how good the revenue growth looks. 3. AI doesn't replace your judgment, but it compresses weeks of analysis into hours. If you're not using it yet, you're at a disadvantage. If this kind of data-driven analysis is useful to you, hit subscribe. Every week, I break down one company, one data set, or one investing concept, using the same AI-assisted approach. Next week, I'm going deep on the single highest scoring stock from this analysis. Full breakdown of the business model, competitive moat, financial history, and what the AI thinks about its future. Don't miss it.